Welcome to USMK Insights, where we focus on US stock technical analysis. Using charts, trends, and price action will help you understand the market rhythm and make informed buy and sell decisions. Alright, hit subscribe and let's begin today's learning journey. Hello everyone. Today we're focusing on how to use the RSI indicator. RSI stands for Relative Strength Index. It measures the magnitude of price gains and losses to gauge the strength or weakness of a trend. This helps us anticipate whether the trend will continue or reverse. In simple terms, it shows how strong the upward price movements are as a percentage of the total movement. The higher the volume, the stronger the market. The lower the volume, the weaker the market. Simply put, a high RSI reflects strong recent gains, and when it's high, it signals strength. The market is in a strong uptrend. At that point, you will see some key RSI levels below. Let's take a look. First, we have the 80 level. The top limit is 100. RSI ranges from 0 to 100. Key levels to watch are mainly three. We divide them into four zones. If RSI is above 80 in the 80 to 100 range, this is known as the overbought zone, right? It means the market is extremely strong and prices have surged sharply in the short term. A pullback may follow soon after. That's an overbought zone. Next is the 50 to 80 zone. Between the 50 and 80, the market is in a bullish phase. Buyers are clearly in control. When RSI drops from 50 to 20, it signals a weak market phase. This suggests a downtrend or a correction. Bears are in control. If it falls into the 0 to 20 range, especially below 20, the market is extremely weak. This is an oversold zone. At this point, a rebound or recovery may follow soon. Each RSI zone represents something different. They signal different conditions: extreme overbought, bullish strength, bearish strength, and oversold. The oversold zone shows strong bearish momentum. These four zones guide how we use RSI. Let's look at how to apply them. We will start with the overbought and oversold zones. Overbought refers to RSI above 80. When RSI is above 80, it signals extreme bullish momentum, usually after a strong price rally. If RSI turns down from that overbought zone, especially when the fast line curves downward, watch for the shift. Focus on the fast line. When it turns down from overbought levels, it signals a move from strong momentum to correction. The market is likely entering a pullback. At this point, we should start trimming short-term long positions to lock in profits. Let's also look at the lower range. For example, when RSI is very low, deep in the oversold zone, like in this area, that means the market is extremely weak. If RSI starts to turn up here, that's a rebound from oversold. It signals a technical bounce. We call this a shift from extreme weakness to short-term recovery. If you are holding short positions, this is a good time to take profits. Once RSI exits oversold territory, you should consider closing shorts. Scale out gradually. Now, if you're looking to bottom fish, this zone is okay for a small speculative long. Because after heavy selling pressure, the market is turning up. This is a technical rebound. So here, you can try a small long position, but keep the size light because this area is still within a bearish zone. The downtrend remains strong. It's just starting to show signs of recovery. At higher levels, like here, when RSI is extremely strong but starts to drop, this signals a potential pullback. It's a technical correction. At this stage, you can consider closing long positions and trying light shorts. Take profits on earlier short-term longs. Scale out gradually, then open small short positions, but keep the position light. It should be smaller than your previous line exposure, usually just 20% to 30% of a full position. That's already enough here because this is only a technical pullback, not a full trend reversal. The uptrend is just easing from its peak. A correction begins, but it's not a bearish reversal yet, so don't confuse the two. That's an important distinction. When doing counter trend trades like this, make sure your positions are light, just 10% to 20%, just testing the setup, right? It's better to follow the trend upward when it resumes. That gives higher probability. Stick with the bullish direction. Trade in line with the uptrend. It's usually more effective. Longer signals that way. Counter trend trades must stay light. That's how we use RSI in both overbought and oversold zones. When RSI is already at extremes, don't chase the move. Wait for a reversal signal. Then consider small counter trend trades. Now let's look at a second RSI method. It involves using the fast and slow line crossovers. First, here's the fast line. Take a look. This one is the fast line. And this one, that's the slow line, right? Fast and slow lines. And this one, that's the slowest line. Generally, just using the two main lines is enough. When the fast and the slow lines form a crossover or death cross, what does that mean? Let's see. When RSI pulls back from a high level and a death cross appears between the fast and slow lines, like it does here, it signals the market is shifting from strong to weak. At this point, we can consider opening small short positions. That's right, start building shorts here. The strong market structure has started to weaken, right? Now, if we see this at a low level in this area, for example, a golden cross appears where the fast line crosses above the slow line. That would correspond to this price level. It signals that the bearish correction is ending. The downtrend is losing steam, and the market may return to an uptrend. This is a good time to build long positions, so buy on golden crosses and short on death crosses, or reduce longs when a death cross appears. That's a strategy you can follow. Now, at this point, if you're taking a counter trend trade, keep it light. The upside potential may be limited. The move could be small because you're trading against the trend, so be cautious. Trades that follow the main trend like bullish setups have more potential. You can afford to be a bit more aggressive with those, but be conservative with counter trend trades. This applies to crossovers at extreme levels. For example, a crossover in the overbought zone, if that happens in this area, and RSI pulls back toward 50, it indicates the overall trend is still strong, but undergoing a technical correction. If RSI holds above 50 at this level and then forms a golden cross again, it suggests the prior correction is ending. A new bullish leg may be starting. At this point, it shows buyers remain strong. That last dip was just a technical pullback, and now the broader uptrend is likely to continue. This would be a good time to consider going long. Open some long positions. At the same time, we can see from this point, RSI drops from the overbought zone all the way down into the oversold area. At this point, we can be a bit more aggressive and consider short positions. Why? Because now RSI has fallen below 50, especially the slow line crossing below 50. That shows growing bearish momentum. At this point, the downtrend is strengthening. This suggests a shift from bullish to bearish trend. The uptrend is weakening and turning into a downtrend. So when assessing the trend, watch the slow line. For cross signals, look at the faster two lines. They give quicker signals. That's usually more precise. Alright? Now let's see crossovers at different RSI levels also carry different meanings depending on their position. When RSI drops below 50, it signals a shift from bullish to bearish momentum. At this point, you can consider adding to short positions. If RSI falls from the overbought zone but holds around 50, it's just a technical pullback. Only when it breaks below 50 decisively, a clean break of the 50 level, does it confirm a real trend reversal from bullish to bearish. That's a trend change. The earlier move was just a correction, so the nature of the move is different. One is a pullback in an uptrend, the other is a full trend reversal. They are not the same. So right here, it's reasonable to add to your short position. Earlier, we shorted lightly to test. Now we are confirming and scaling in because the bearish trend is clearly gaining strength. Alright, the reversal logic also applies. For example, if the slow line stays below 50, we're in a bearish trend. In this bearish trend, if RSI starts to turn up, we could consider what? Opening small long positions, but they must be light, or stay on the sidelines. If RSI turns back down below 50 again, that confirms the downtrend is continuing. At that point, you can add to short positions. So we use the 50 level as a key line. Above 50 is bullish, below 50 is bearish. If RSI pulls back but bounces above 50, it means pulls are returning. That's chance to follow the uptrend. But if it stays below 50 and turns down again after rebound, that's a signal to short. It's a high probability setup. This part is key. 50 is a dividing line between bulls and bears, using the slow line to determine that. Above 80 is the overbought zone. Below 20 is the oversold zone. These extremes often lead to reversals, but they usually trigger technical rebounds first, not full reversals. So keep that in mind. Also, price and indicators can sometimes move in opposite directions. In other words, they diverge. What does that mean? Let's look at this example. Look here. Did the price make a new low? Yes, it did. But did the RSI also make a new low? No, it actually bounced upward here. The indicator moved up, right? While price kept falling. What does that tell us? It signals a possible trend reversal. Now take a look again. Price moves up, but RSI heads down. That's called bearish divergence at the top, a classic top divergence. It shows the bullish trend is weakening. When bullish trends face like this, a reversal may follow. The trend could flip. This is what we often call a divergence between price and indicator at the top. This type of divergence signals that when it happens a second time, like right here, that's a clear short opportunity. You can take a short position here. Alright, divergence at the bottom is called bullish divergence. At the top is called bearish divergence. We short on bearish divergence. Take action when it happens. After bullish divergence at the bottom, or even after 2 or 3 divergences, at that point, we choose to go long. Start entering positions. Makes sense, right? So this is how we use divergence, the relationship between price and indicator, to spot when a bearish trend or a bullish trend starts showing signs of reversal. It indicates a shift in market momentum. When that shift happens, we reduce previous long positions and prepare to go short. That's the idea. At the bottom, it works the opposite way. We reduce short positions and then try a small speculative long just to test the waters. This is a type of early entry trading. Alright, now RSI is one of the indicators we use most often. It's widely used in practice. Its strength is sensitivity, but its weakness is the high number of signals, including a lot of false ones. Like in this area, you often get misleading signals. So what do? We combine RSI with moving averages or use it alongside the MACD for confirmation. For example, if price is above the 60-day MA, we only take long trades. When we see a golden cross like here, when the fast line crosses up, when that happens, we focus on longs, right? On pullbacks or during counter trend moves, we skip trades. But when a golden cross appears again, that's our signal. What do? We can add to our long positions, add to longs, and ride the trend. You can use MACD or moving averages to help determine the current trend. Once the trend is clear, then look to trade in line with that trend. or when signals align. In other words, when indicators resonate and point the same way, that's when you take the trade. This greatly improves your accuracy and success rate. Alright, in this setup, we only go long. Enter on golden crosses. Ignore the pullbacks. When price pulls back, don't trade, right? By doing this, your win rate, your probability of success goes up significantly. Alright, today we cover the oscillator, the RSI momentum indicator. We discussed its strengths and weaknesses and how to manage its limitations. I've just walked you through how to apply it in real trading. We have covered a lot today. And I'd say this is one of the more in-depth RSI tutorials you will find when it comes to technical analysis. We broke down trend direction, right? How to identify bullish strength, where both are in control, where it's overbought and where it's oversold. Overbought and oversold zones are often just pullbacks. Only when the slow line crosses above or below 50, that level, does it signal a trend shift. So we must pay close attention when the trend changes direction and be ready to adjust our strategy.